All right, this is Obaid on behalf of Electronics, and in this video, we'll be looking at another graph showing federal surplus or deficit. Okay, we know that federal surplus is caused by having more revenue than expenses, and federal deficit is caused by having more expenses when it comes to government spending compared to revenue. Okay, as you may notice from 1952 to 2020, okay, the general trend over here on this graph is of a federal deficit, okay, which means the tax revenues are less than your government spending and borrowing, okay. And we've talked about some of the factors that impact government spending, okay, some of the things that government spends their money on, okay, and those are listed at the bottom over here. All right. So whenever you have a federal deficit, okay, you have to consider um, the impact of a federal deficit on things like private savings, okay, as well as okay, your private investments, okay, trade deficit, so on and so forth. Okay, and we know what the formula is, okay, when it comes to your private savings. Okay, let's, this is your private savings over here. So in terms of your private savings equals private investment. Okay, this is private investments. Okay, plus government deficit. So this is government deficit. Okay, your trade surplus. And again, your private savings has to do with savings of households in the banks, as a result of which banks may be able to buy financial instruments from the government. And those instruments include, but not limited to, treasury bills and bonds. Okay, when they buy treasury bills and bonds, the government is able to borrow more money, spend more money. Okay, when it comes to a trade deficit. Okay, which basically means if you do have a trade deficit, if you do have a budget deficit, okay, the private savings, okay, will take a hit as well. All right. So if you have your government deficit, for example, because government deficit is directly proportional to private savings, as government deficit goes down, so will your private savings. All right. And when it comes to private investments, we know that private investments, and this has to do with investments by firms and businesses. So we're talking about capital expenditures. So your private investments over here, okay, they equal, okay, government deficit, okay, plus trade surplus, okay, minus private savings. All right, so this will become negative. This will become positive, okay, and this will become negative. Okay, so your private investment will be private savings, okay, minus government deficit, minus trade surplus. Okay, as government deficit goes up, your private investment or capital expenditure goes down. And the reason why it goes down is because when government is in a deficit, if there is a budget deficit, okay, the government will borrow more money from the sources that we've talked about in the past. Okay, as a result of which your private investment will go down because there is less money for the firms to invest. As government borrows more money, okay, firms invest less money. Firms borrow less money. As a result of which it's inversely proportional, okay, to government deficit. Okay, and same with private savings. Okay, as private savings go up, your private investment goes down. Okay, they're inversely proportional. So as households save more money, okay, capital expenditure